It has been a rough ride lately for BlackRock shareholders. The stock is down almost 40% this year. Earnings this morning did beat estimates. Outflows from BlackRock's funds caught the market by surprise. This is the time when you want answers from the CEO, and we are about to get them. Our Erik Schatzker is here. He has an exclusive interview right now with BlackRock CEO Larry Fink. Erik?
Margaret, thank you. Larry Fink turned BlackRock into the world's largest asset manager when he closed the deal for Barclays Global Investors last December. Now he's got to prove it was the right deal at the right time. Larry Fink is with us right now. Larry, great to have you as always. Let me ask you this question to start off. We just noted the fact that the stock is having a bit of a rough ride, and some people might say it's getting clobbered. The question for you is this: why is it that you and BlackRock are having trouble delivering, it would seem, what investors want and expect right now?
Well, I think, first of all, we are delivering. Our revenues were up this quarter, which is unusual for a lot of financial institutions. I think expectations were very large after we announced our merger with BGI last June. We did see some very large flows between June and closing of the BGI transaction in December. When I spoke to you, Erik, in December, we did say we expected merger dyssynergies to happen, where we had large concentrations of assets with some of our most favored clients, and we expected those outflows to be significant at the time of the merger. We factored that into the merger, and we're seeing that. We did see over the first 6 months over $17 billion of flows in iShares. We saw in organic growth in the second quarter $28 billion that were merger-related outflows and non-cash outflows. And so I would say we are delivering. And most importantly, we are building a platform that I believe will be in our clients' needs for the future. We do believe that we need to have a much more global presence and a global platform, and we're building that out at this time.
Larry, give investors something to be optimistic about when it comes to those fund flows. This past quarter, they saw $30 billion, at least clients take $30 billion out of the firm. What is BlackRock going to get in the way of inflows? Give us a sense of what we might see in the coming quarters.
Well, once again, we did have quite a bit of inflows. When you talk about the net, that includes the liquidity and cash, where the industry as a large is seeing some very large outflows. The liquidity management business is under a lot of duress right now. Money market funds were just not competitive versus bank deposit rates. Banks were offering a higher rate. We are seeing some very large opportunities ahead of us in Europe and in iShares, where we continue to have a 46% market share in our business. So I believe today we are more poised for growth opportunities than we ever have. We just completed a large integration in terms of our culture and leadership. We announced a new leadership team. We announced a new global governance platform. And so, we are quite constructive on our business model, and we are starting to see the more comprehensive dialogue with our clients. Clients are looking for more solution-based decisions. They're looking for multi-asset class strategies, and no other firm in the world has our depth of products and our global footprint.
Larry, you mentioned Europe. Let's talk about the EU sovereign debt situation. How do you think that story is going to play out, and how will the stress test results we get this Friday play into it?
Well, we've seen a significant rally in much of the Euro sovereign credits. I think pessimism was way too great in terms of how problematic Spain and Italy and Portugal is. And I think people were looking for, a social unrest in Europe as a result of the austerity plans. If you think back, the problems in Europe really started to materialize in May, and they continued to worsen between May and June. But these European countries have put in place very strong reductions in their public spending. They are finding ways to reduce their deficits, And what we were frightened at BlackRock was, are we going to see social unrest? And to date, we are not seeing that. And so I think because of the fact the social unrest is very muted, you are seeing protests and strikes, but they're very modest compared to what we saw in Greece in May. And so I believe people are relooking at what's happening in Europe. Importantly, if we continue to see calmness in Europe between now and the end of summer, where unrest generally is the most pronounced, I think we're going to have a significant rally in the sovereign credits and in the European markets. People are very short European markets. Pessimism was very large. The euro is back, it was flirting with 130 earlier this week. Maybe it's 128 today. So we've seen a significant rebound from the low levels. And when everyone was pronouncing that the euro was going to go to 100, we had a big rebound.
Larry, did you put money to work in European sovereign debt when those prices got to their most distressed levels?
We did as a firm. We were actually short sovereign credits, and in early June we started paring down our short. We have probably at best a neutral position now, but we did take advantage of our short position relative to the indexes, and now we are basically flat versus our liability. So we are long sovereign credits as a firm.
Larry, people talk about the concerns that were expressed about European sovereign debt coming to visit the U.S. and the Treasury market. How confident are you in Treasuries as an asset class? And if you are comfortable with them, just how much longer can the rally that we've seen continue?
Well, Eric, this is a central theme that we're going to have to really focus on over the next year or so. We've seen a very large run into U.S. Treasuries, the two-year Treasuries trading approximately at 60 basis points. So we've had a huge flight to quality as people ran away from the euro and European sovereign credit. And so I do believe we are going to have much greater focus on how we navigate our deficits in our country. We are looking at not only a federal deficit issue, and we have not addressed our deficits like the Europeans have to date. And also, we have in front of us more immediately are the deficits that the states are living with. They need to find ways to reduce their deficits. This is going to put some stress in our economy as these states try to manage their deficits. It means probably their public spend will be reduced, which will further aggravate our economy.
Larry, if that's the case on the fiscal side, and if there is going to be this rally you foresee in European sovereign credit, does that make Treasuries a sell right now?
Well, until people start looking more optimistically in global equities, I think you're not going to see any real pullback in Treasury rates. There's no question we could see the 10-year Treasury to move back to a 320 level from the 295-ish level where it is today. So we could see some tactical trades around there, but I think we're going to be in this low rate environment until we start seeing the U.S. economy restabilizing itself. We went from a high 2, low 3% GDP to something probably closer to a 2% GDP. And so we're not able to get this economy going to accommodate the needs to bring employment to better levels.
Well, much of the income that BlackRock generates depends on asset prices. Overall, if you look at everything you're invested in, do you feel comfortable about the direction of asset prices, the way you're positioned?
Well, I do like credit. I think if you think about where do you think equity markets will be over the next 10 years? Can equity markets grow at 6% a compounded return, or 10, or will it be 0 like the last 10 years? That's a very important question to be asked. We think it's going to be closer to 6 or 7. And then if you look at credit, and if you look at, let's say, double B, high yield credits, you could earn 7.25. All right, U.S. corporations their balance sheets are probably the strongest they've been in years. And so you could make a statement that credit with a long-term outlook of 6 or 7% for equities is still a better risk-return investment. If you believe that equity markets can surprise everybody in the upside at 10 or 12%, then I would say, obviously, you need to put more of your money in equities. But we have more of a modestly constructive view on equities. We have a much more constructive view on equities outside the United States and the emerging world. We believe a continue investing in non-dollar-based assets is going to be a great differentiator in returns in the future.
Larry, thank you very much. Some extraordinary insights from the man who runs the world's largest asset manager, Larry Fink, CEO of BlackRock.